I'm Alex Gurevich, the founder and CIO of HonTe Investments, and I'm delighted to have as our guest today John Burbank, the founder of Passport Capital. He founded Passport Capital, I believe, in the year 2000. And it's been very successful and very well known in the knots during the times leading up to a financial crisis. Very successful fund. But I'm particularly excited to have John here because not only we're in a closed space in this building, but we're also in a closed intellectual space, I believe. We occupy a similar intellectual space, though we trade different products. For me, it is important that, like myself, he's engaged in long horizon thinking and trying to understand what things really are and seeing forest behind the trees and trying to understand that regardless of current market noise or current perception, where a certain price or asset is likely to be 2 years from now, not by this afternoon at the close.
Right.
And that's why I think we can speak the same language even when we talk about different products. When you end up being a contrarian, you're against 90% of the market, and yet you sit there 95% sure that you're right, while 90% of smart people are wrong. In 2004, I said, one should buy every deferred Euribor contract of any maturity if it trades below 100. So basically in 2004, I made a statement that European interest rates will be zero negative in perpetuity, which was probably 10 years before its time. I don't think that was as much a brilliant, it was some kind of mixture of a brilliant insight and some luck. I was just frustrated with the inefficiency of European Union. That's really what was speaking in me. I didn't have that strong perception how Europe will really play out, but I said it and it carried some weight back then. Now, what I would like to kind of open up with asking John is like, what are the instances, maybe bring up some historical examples from your career when you could really nail it, and how would you attribute some of it to luck and some of it to what it is that really allows you to nail it?
Sure. So probably the best thing to start with is that I started in January '96 at a small hedge fund here in San Francisco doing emerging markets. And emerging markets were a relatively new asset class, and so there's a lot of excitement about it. But I'm sitting in San Francisco doing emerging markets, and our fund went up every month from January '96 to October '97, and then EM collapsed, and people did not predict that. And the U.S. kept doing well. It bottomed in '98, about a year later, and then the U.S. went up to a bubble, and nobody predicted that. So I guess early in my career, in the '97, '98, '99, and then 2000 period, what I saw was two things: a 90% crash in EM in a year in dollars, and a huge bubble on things that didn't make any financial sense. What I saw was it's possible for liquidity to take prices very quickly to places nobody ever predicted. And I came up with this view that maybe financial markets aren't nearly as smart on a longer term basis as you think, and that the very improbable or impossible happens on a regular basis. And so what I like to think, my hypothesis was, maybe you can actually identify places that would create that asymmetrical or high leverage situations, but they had to be things that had never happened before, I think. Because essentially people look backwards and extrapolate forward. They look at a chart backwards and they think, it's going to go, if it's down, it's going to go up, it's going to go down. They regress to the mean, basically. But the world moves forward, the world progresses. And essentially, the other principle is that I like to say price is a liar, meaning if the massive liquidity has moved so much to one direction, and it's pricing in something, but it's not actually true, or it's not going to be true in a month, a year, 2 years, the liquidity is going to change directions, and therefore you're going to have a chance to either make or lose a lot of money. So what I've tried to do is to understand many different asset classes, many different markets, to put together an understanding of where prices are, where liquidity is, and then match it to the fundamental changes in industries and companies and perspectives. So if you go back to 2000, right, August of 2000 is when I started, just before the US market rolled over. We've had, the world has changed immensely. China wasn't even understood to be a demand driver for commodities until 2003. Tech was this bubble. It was forecasting incredible promise, but that promise didn't really become, I think, discounted in markets until 2013 when growth stocks really started outperforming. Price is really just the balancing of liquidity. It is not the proper discounting of the future. So the question is, where is liquidity now relative to where liquidity is going to be in the future for fundamental structural reasons? And so I use, one way I use it is go back 5 years. 5 years is a long time in the financial markets. So go back 5 years, in this case 2014, middle of 2014, and think about what the world thought was going to happen and compare it to where it is now. Go back 5 years before that, 2009, right? And think about what you thought about the world then versus where it was in 2014. I mean, 5 years is a long, long time because liquidity has a chance to move, dramatically to one place or another. And I'd say markets are more efficient now. I think, the most powerful, dominant companies in the world are generally U.S. and some Chinese internet companies, and I don't see a lot of vulnerability there. And I think the liquidity of the S&P, the governance of the S&P, which is incredibly different than it was 10 years ago, is reassuring to people. But now we have a big difference in the perspective of U.S. Fed governors and long-term structural trends that I think creates an unusual once in a 10-year bet that anyone can make, which has really got my focus.
So I think the origin of the idea for this interview was started possibly with a conversation we had about 6 months ago. It was exactly 6 months ago. It had to be first week of January.
Mm-hmm. Yep.
I remember I was on vacation in Hawaii, and you reached out to me to discuss calls on Eurodollar futures.
Yes, exactly.
And the interesting situation was then that was when the market just went through this liquidity risk squeeze and a risk-off scenario of fourth quarter 2018. Mm-hmm. Fixed income market got out of pricing imminent tightening cycle. But once we rebounded from the absolute lows of the stock market strongly bounced last few days of 2018. It continued to rally into early 2019. Mm-hmm. We went into this environment that is basically on hold for the rest mm-hmm. of the year. Mm-hmm. And as far as I remember, the implied volatility on Eurodollar futures, by the way, for listeners who are not familiar with them, those are contracts on forward interest rates. Mm-hmm. And basically those are the easiest to trade contracts which reflect future Federal Reserve policy. Mm-hmm. The volatility was extremely low, close to like record low, or at least lows for quite a while, implying very low likelihood of any kind of action.
Right.
And we started talking about this, and I think we were both of a strong opinion that rates were actually going to be cut this year, mm-hmm. and there was an opportunity there. And so this is a good segue into discussing why you were so convinced, mm-hmm. why you think, and also why you think that you were so convinced while a lot of people were still either calling for Fed on hold or even expecting as the dust settles for hikes later in 2019. I mean, a lot of people were still calling for hikes in the second half of 2019, which, of course, in hindsight looks preposterous. But the interesting thing that it looked preposterous for you and me back then.
Yeah.
So what is that
sure.
allowed you to outmaneuver people, and what was
sure.
the trade, and what is that allowed you to outmaneuver
sure.
people so much?
So starting in that January 96, I've seen a few different cycles for all different reasons. The pro-cyclical CapEx bubble of the internet build-out in the late 90s, and then the Greenspan created credit bubble and the Wall Street, leveraging of the investment banks, right, and all the banks with a crappy product of subprime, and that blew apart. And we have a different situation because the world moves forward so much, in 10 years. And so we have a different situation, which was also not believed, which is more like we were talking about the Euribor bet, which is rates in the developed world outside the U.S. are 0 to negative, and the demographics are supporting that idea, right? Finally, we also have, I think probably the biggest thing, although certainly not the only thing, is we have this trade war, which is essentially the crystallization of a long-term structural bet by the world on globalization. 2016, we had Brexit in June, and then Trump election in November. So in my opinion, those you should put together, because it's finally a group of people who I think have been hurt by globalization were identified, well, in Britain's case, they didn't realize that was going to be the result. But in Trump's case, I think he identified that, and they barely elected Trump, and he has supported that platform. So in my opinion, that is the crystallization of a multi-decade process. And if you want to see a really good forecast of this, you should see on the Charlie Rose show, Jimmy Goldsmith in 1994 campaigning against the GATT treaty, saying that all it was going to do was put out of work a huge number of people in developed markets. And despite being a libertarian billionaire, although he was an MP of Europe, he accurately forecasted what was going to happen in 1984. And the world went forward, enfranchised EM labor, which was very, very cheap. It did incredible things for EM, and it ultimately, though, misled a large group of, my guess you'd say, the middle class in the developed world. And so 22 years later, in 2016, you had Brexit and the Trump election. And in my opinion, that was the crystallization and the backlash to globalization. The trade war with China is the next step of that. So I look at this as this has never happened before. We've never lived through a fracturing of the world, I guess, since World War II, I suppose. The Cold War was basically the outcome of a separation and fracture. But we don't know how serious this is. And the market, I'd say, has consistently underpriced the result of that trade war. They keep thinking there's going to be a truce, just like the Trump, I don't know what Trump exactly thought he was accomplishing at the G20. But this is as big a thing as there exists. This is a war. This is a tipping point of recognition now. Trump brought this from his base, but now there's bipartisan agreement, essentially, that the U.S. has to partition China, essentially, to limit China's power and ambitions. How many bigger things are there to suddenly occur? So I'd say that these things that haven't happened before are difficult for a group of people or individuals to properly discount into the future. Yet it's consistent with this demographic, this slowing trend, this disinflationary trend that you can see if you just look at the 10-year Treasury over the last 20, 30 years, this demographic trend of low birth rates in the developed world. And essentially, if globalization was good for growth, the fracturing of globalization, the limiting of globalization has to be bad for growth, right? It has to be, unless it's met with a massive fiscal stimulus, I guess, which is temporary and inefficient in
But is
nature.
it also, do you think that the breakdown in globalization is also deflationary, or is it possible to be inflationary in terms of its impact
yes.
on the interest rates?
So right now, I think it's deflationary because there's a pulling back by companies and corporates, because they see this. Their confidence level has dropped tremendously. So their plans to spend I think have been reduced until there's more clarity. So I think we're at this point where companies are pulling back more and more. We're seeing it in copper, we're seeing it in oil, we're seeing it in how rates are trading. We're seeing it in the PMIs of China peaked first, then Europe peaked, then the US peaked. So the question is, when will this be transferred to the consumer, which I think it is. But the point is, I don't know what's going to happen. All I'm saying is this isn't a temporary event. This is a structural event born out of the last 20, 30 years. And finally, there was an identification of a group of people who have been disadvantaged. It's now spread around the world, right? So in just 3 years from that tipping point, I just don't see it's going to get put back together. This is a partitioning. So it's right now it's deflationary. I think on a nominal basis, it could be inflationary because of a less efficient means of production and costs, et cetera. But I think if that's the case, it's bad for real growth, without some massive fiscal stimulus. So in essence, I end up with it's deflationary, and there's going to have to be some, much greater policy actions to support this. We've gotten used to, in the last 10 years, we've gotten used to Congress doing very little and almost nothing after the first 2 years of Obama administration was done, and the Fed doing everything. So rates were at zero for 7 years. Another thing to think about is the first 2 years of the Trump administration is different than the second 2 years. Like Obama had the benefit of the Democrats having both the House and Senate. He passed the healthcare deal, and nothing else really got passed, nor did he really try to do a lot for business. Trump's first 2 years promised to do a lot of things, and I think the animal spirits lift in the U.S. Was there. He also accomplished the tax cut, which was pretty stimulative. So I think the first 2 years of Trump, with the Republicans having House and Senate, he got something significantly done for Americans and corporates, and there was a stimulus, and there was this burst of enthusiasm. But now the second 2 years, the Republicans don't control the House, and there's a huge backlash. There's a huge separation, as we see, that I think is going to last for 10, 15 years between liberals and conservatives. But really, it's these. It was globalists and the backlash Trump supporters. But even that has become. I think there's a basic agreement that we have to limit China. So what I'm left with is, for these 2 years, these last 2 years of Trump, he doesn't have the power to make things happen the way he did the first 2 years, and we're going to suffer from the year-over-year comparisons from those first 2 years. Plus, we have the outcome of the trade war. Plus, all the liquidity that was put into the market in 2016 after a very bad 2015 by Europe and Japan, everything. Everything rose up, and now it's been falling as by the PMIs. And China was the first one to peak, then Europe as a quarter later, and then the U.S. So I feel like it's kind of like looking at a patient. If you're a doctor, like if you only want to see the good parts, you could say this person is really healthy. But if you actually looked at the full patient, you could see a lot of problems and want to prescribe things. Somehow the Fed only changed their mind when the S&P fell 20%. And if you look at the S&P, you're being misled as to the health of this patient. In a way, I could say it's just capital accumulating to the best companies, strongest companies in the world, the most liquid situation. But many of the things in the world are showing poor health, and the gap of rates from the Fed to the rest of the world is really, really large. And so the getting down to the trade in question, other than that fourth quarter where equities fell and then have rebounded, how do you hedge yourself from this trade war being far worse by the disinflationary impulse around the world, going to levels that people don't expect? So that's what you have to guard against. And so I guess the point now is, what I've seen in almost 30 years is that every 10 years, when you get to the end of a cycle, a long hiking cycle, a long growth cycle, and we just made it the longest expansion ever, I think just this week, you have this opportunity or risk of a quick down cycle. And I didn't have the training or understanding about how to use fixed income instruments in 2001 and in 2009. In 2001, I was short a lot of bubble equities, and the S&P went down, and I figured out places to be long that ended up being commodities. That was a great story. In 07, 08, in 05, I identified subprime mortgages as the place to hedge my portfolio. It didn't start paying off until February of 07, and I held it through 2010. I held it a long time. But this is different. There's an opportunity now to hedge yourself through betting on lower rates, and it's entirely different than what I knew before. And so the point of this is, I think, there's going to be a lot more policy needed than the Fed governors around the world think. In 2015, which was the after effects of the shocks of the end of QE, where the dollar rose 20%, end of 14 and 15, that created a lot of problems. So I think this second 2 years of Trump, where he can't do a whole lot, this trade war now, all these things were not, forecast very well by the market, and yet it's not to say that there isn't real reasons to be long, the best tech companies or tech generally. That is just the structural long-term trend. And so if you just look at that, you'd say there's no need for rate cuts. But if you look at copper, negative rates around the world, China's deteriorating, PMIs, they have a lot of debt, they have a lot of potential issues. I'm worried about these things going way farther faster than the market expects. And so I started looking at it in October, but I didn't have any expertise in this. And so that's why I reached out to you in January. And I came to the conclusion that if rates have to be cut, like the last 2 cycles, there's a good chance they're going to be cut all the way to zero. And because capital had massed so confidently on a bet on hikes, the Fed was saying 3, the market was saying 2. Liquidity had priced something that wasn't going to be true. And so there was a chance to bet against a well-informed American view, yet the rest of the world, the rest of the commodities, had already started peaking. So the way I look at liquidity, the first to peak was Bitcoin in December of 17. That was a global phenomenon, and obviously not as liquid, but that was a sign like of liquidity peaking. The second significant peak was late January 18 when EM peaked, and it was a very steep ramp in January. It peaked, I think, January 26th. It was exactly when the dollar bottomed. The dollar, essentially what happened, we had the end of QE in middle of 14. The dollar went up 20%. The Fed never thought this was going to happen. In 15, all the commodities, the whole world went down because the dollar rose. And then they come in with all this liquidity. They make things rise. But then Brexit happens, Trump gets elected, and suddenly we're in a different, real environment where voters are calling shots. And the Trump election for 7 weeks propelled rates high, believing there was going to be a lot of action. And after 7 weeks, it peaked, and then the dollar fell all during 2017. And the dollar falling means that asset prices are likely to go up. So 2017 was a great year for assets, and Trump really couldn't do much in the first year. It's hard to get a lot done in the first year. It was January 2018, the dollar bottomed, EM topped, and EM started falling. Of course, the S&P fell down too, but then it kept rallying. So in August of 2018, small caps in the US topped. And then at the very beginning of October, right after commentary by the Fed that they're a long way from neutral, the S&P and NASDAQ topped, and you had this big correction. That's what made the Fed change their policy course. But since then, they've been very reluctant to believe that they're too tight. Yet all these fringe asset classes are showing you that we're past that point of liquidity. So anyway, what I like about this trade is that we're not betting on like where will traders mark gold in a year. We're not saying where will the multiple of S&P earnings be. We're not saying even where will the 10-year trade. What I like about betting on with Eurodollars and betting on Fed futures is that we're betting on where the actual policy rate is going to settle. It's like betting on the earnings. It's like nailing the earnings of an equity, but not having to worry about the multiple.
Right.
It's really for someone who's done equities and particularly shorting equities. When you know bad things, if you have positive guidance, you're screwed. So anyway, it's talked a long time, but the point is, we're in this really interesting situation where the world has been fooled in a way that normalization is ahead, and yet the structural reality of Brexit and Trump and the recognition around the world is, and then now this trade war. Oh no, the world is now structurally different. Globalization's gone too far, hurt too many people, And now that backlash, I think, is a long-term thing. And China is a bipartisan now recognition of this. So I don't see how we have any kind of real hope of a move back up and to the right. Yet policymakers seem to think there is this chance, which is why they're so reluctant to acknowledge that they've been too tight. So anyway, that gets to this trade, and I've learned, I've been able to focus a lot of time to learn Eurodollar's trade, how calls are priced, and I've come to the conclusion that betting in this situation, once every 10 years, get to the end of a cycle, betting on owning calls, particularly with this leverage, on a lower rate is far, far superior to any other way to hedge yourself. It's far better than owning out-of-the-money puts. It's far better than owning calls in gold. It's really a compelling thing. So that's where it took me a while to get to that point. I wish I had known this, in 07, 08. I wish I'd known this, in 2000, 2001. I mean, rates fell 500 basis points in those two. We only have 237 basis points to go to zero.
Well, this is a very interesting, because what I hear from you talking, one of the most interesting threads that you're repeating about how your trademark is to bet on things that have never happened before, how you're looking for those structural shifts and actually willing to put your money on it. And there might be a little difference between my approach and your approach to that, because that's a very much of your marquee approach.
Yeah.
My tendency is to bet on historical patterns repeating. So I like to bet on things that happened before and kind of ignore things that I don't understand. So to your point, I also traded through all those cycles, and I started as an interest rate trader. So I had advantage on stumble on the concept, or whatever, discover independently, if you wish, the concept of risk parity in 2002, and the idea of using interest rate instruments as a hedge to equity position. So for me, this is a well-played scenario. I'm just playing the scenario I played many times over and over, as opposed to doing something new. What I find is interesting is your strong view on impact of trade wars and deglobalization, whereas I'm kind of finding myself, I don't really know what's going to happen there. So I appreciate the fact that you have strong view. And I also find myself, and I want to put it to you again, a little worried in terms of, if you look at it as not as a hedge, but as a pure bet on interest rates going to zero, I am still worried about further fiscal impulse. I'm worried about MMT if Trump loses election. I'm worried about, if Trump wins election, about infrastructure deal. I'm worried about fiscal impulse from China, because China does need bipartisan support for fiscal impulse. Of course, you can have your view, but you always... So to me, those two things are kind of create this sea of uncertainty.
So let's go through those. So we are betting on something that's happened before, which is rates dropping dramatically.
Correct.
Right, at the end of a cycle. So that's reassuring. It's just that the evaluation of that possibility has been so limited. We talked to about 10 institutions, and it became very apparent right away that they had no interest for all kinds of reasons. Number one, none of their managers were doing it, right? So number two, it was completely contrary to what they had learned the past few years. So they thought, why would we need this? And third, they no longer thought they really needed a hedge, a tail hedge. We've learned since 2009 that we're going to be taken care of by central banks. Like, things aren't going to get that bad. They're going to go do something. What was funny is that I was basically saying, yeah, and that's why they're going to take rates to zero when there's a problem. So, and you can make 10x, 10x on this, and they just weren't interested. They they set aside the possibility. It was really like in 506. When it was clear that if home prices do not appreciate for 3 years, the subprime, the triple Bs were going to zero, there was no belief that prices could actually not go up. That's about what the view was among institutions a few months ago about rates. It was just a broad, and it was very helpful, right, to talk to the market and see. So we got no interest, not even a second meeting, and it became clear, okay, good, that's fine. This is, and you can see it in the how people are betting. They're betting on rate hikes. It was really only to the Fed meeting, this recent Fed meeting, that it was ratified for everyone or clear to everyone. Oh, the Fed actually is probably going to cut. Like they made it clear. They don't want to cut, because they're looking at the healthy part of the patient, not the weak part right now. So with the rates markets are saying June, June is really the meat, like between now and next 12 months is when rates are going to go down. There's not that much more in between June and January. And around January, February of 2021 is what's perceived as the bottom of the rate cycle. So what they're saying, and I think the rates market is saying there's 105 basis points of cuts between now and January 2021. I look at this and say, there's so little to cut, and the Fed speaks openly about this, and they've talked about what other things would they need. I think when they realize that the patient really is sicker than they think, that they're going to want to cut a lot faster, and they also know that they have less than half as much to cut as they did in the previous two cycles. So my belief is they don't know it yet because they're really not very good doctors, about the global patient, and they don't understand these things that haven't happened before so well. Plus, there's no really negative consequences to them if they don't have it right. My bet is that the rates markets are probably right. Within the next year, there's going to come a conclusion that they have to do a lot more. But I don't think 100 basis points is nearly enough to get liquidity back again without some other fiscal impulses. So Trump, I don't see why, until there's a crisis, why there's going to be an introduction of big fiscal stimulus, because we have two sides that don't want to agree on anything. So that would argue for after the election. That would be post, that'd be December 2020. Maybe January 21 is the right time for things to bottom. But I think there's a better chance they bottom at zero than 133 basis points, which is what the market is saying. China was a concern because it was China's massive stimulus, quiet but massive stimulus at the end of 2015, as well as they basically got commodity prices up and they levered up again. I didn't know whether China would just do this again, but they decided not to. They decided to try to hold themselves together. And actually the trade war is hurting China because essentially for a couple of years now, they've put on hold the export of dollars, right, leaving the country. They don't have that many dollars really. And I think they're just deciding we're going to hold things together, ease policy, try to restrict dollars so that we don't weaken the currency a lot. I think that's really bad for world growth, and that's what we're seeing in copper and oil. So I don't think China's like this answer unless they were willing to let their currency go a lot. And I don't know what their calculus is about face and where, what in their trade war negotiations where currency fits for them, right? I can imagine them wanting to hold this, keep it below 7, to the dollar. It doesn't mean later if it's just there's no policy, they may decide to, ease tremendously and let the currency go and really put pressure, right, on the U.S. and the rest of the world. I don't know. But anyway, I'm not so worried now because with the House, ruled by the Democrats, and we're in the election period, Trump cared a lot more about the stock market the first, couple of years. He cares about it, but the S&P, the most liquid, best companies in the world, are actually, breaking out to new highs. It's everything else that's not looking that great. Small caps have rebounded, but they're not making new highs. Copper, he doesn't really care, but copper is at risk of really breaking down towards early 2016 levels. Oil just hit the 50 and 200 day and has sold off. That could be squeezed by OPEC. But I think people are still looking up when they should be looking down in the US. The rest of the world, as you said about negative rates in Europe, they're looking down. Today, the 10-year is under 2%. The 30-year is about 2.5%. And the Fed, has rates at 2.5%, 2.25%. And they think, hey, I don't want to cut. Things are okay, right? The market is forcing them. The market runs ahead. What I've seen in the last couple of cycles, the market runs ahead, and it's the Eurodollar market that is the liquid form of this, and it's saying you have to cut. So we know that the markets forced Powell to change course in December, but the rates markets are doing the same thing. The S&P is not, but the rates market, and they're going to cut. The question is 25 or 50 basis points. My view, though, is that I don't see anything on the horizon in China, in Europe, in Japan, in EM, unless the dollar were to really, really fall. I don't see anything to stop this. And it doesn't mean there's not health and power and liquidity and the best companies in the world. There are. But every jobs report, there's the risk that it's undershoots and is showing that the corporate, risk aversion is showing up in unemployment, and with that rising unemployment, you're going to start seeing falling consumer spending, which is the biggest part of our economy, and then it may translate to equities. But you know what? I'm not even trying to be long U.S. equities or short U.S. equities. I don't know what's going to happen there. My wonder and appreciation is that I have identified. This is the third time I had a chance to, play this cycle with Eurodollars, and I missed the first two times because I didn't understand it.
Well, it seems like you nailed it this time. At
Well,
least
we'll
thus
see.
far.
We're halfway through.
It is always possible to lose money, but at least based on market, you nailed it. I want to ask you just for a second, yet stay on stock market, because you were talking, you a couple of times mentioned about this idea of the health and endurance on the strongest companies. And that actually is a subject I've been thinking a lot recently. There is a lot of people who are talking about the fact how stock multiples and all those various measures of stock market valuation have been reverting, and everything points towards a very massive correction at some point. Now, I keep thinking, and this is going to your point of looking at something that never happened before. If the whole world is going to developed market world, going to perpetually zero to negative interest rate environment, then it means that any asset with positive yield whatsoever becomes tremendously valuable.
And the S&P or large caps.
Yeah, if you look at large caps, which are ongoing concerns, it's very hard to put Google out of business now, right? Or choose your whatever.
They don't have a dividend, but yes, exactly.
They have positive earnings.
Yes, right.
So is this possible that we could have possibly even a recession, possibly rates going to zero, but a very significant, even from this point, reprice on the value of positively yielding ongoing concerns? Why the multiples cannot go several times up more?
Yes. So that is essentially what I think is happening. I think what happened is the timing of the rate hike and the comments by Powell, at the end of September, beginning of October, that at the end of the year caused a really unexpected selling, right? And it was a signal that things were too tight. But I think that's a very, managers were very vulnerable, right? Because it's every year they get, they rated for that year and then they move to the next year. So I think the timing of all that led to this big correction. It was also, October tends to be often a month of a poor month or a month of bottoms. But anyway, and that was corrected by his neutrality. But I think you have to look at the S&P or large cap, NASDAQ, et cetera, and tech. These are the A students in the class. It's if you have a choice of where to put your money and to protect yourself, you'd rather bet on the most liquid, best governed, best companies in the world. So I'd say, I don't know where it's going to trade. I can make a case for up or down. But I'd say that the U.S. credit markets are very illiquid now, corporate credit. They've traded way better than I think they should. The treasury markets, which are incredibly liquid, are predicting real weakness. But I think the market does move forward and does learn. For myself, at the end of 2011, because I'm always trying to think what 5 years from now structurally is going to be very, very different. And I came to this conclusion that the way tech was changing and constantly moving forward, not mean reverting, was my hypothesis, and this was the end of the commodity cycle that I'd played for 10 years. My belief was that human capital, the best human capital, the A student in the class, was actually gaining tremendous value because the cost to start a company or create an application or whatever was just getting cheaper and cheaper. And so I turned my focus for myself to try to understand that. I'm not a technologist. I started investing in a lot of startups and early stage venture. And but it wasn't until second quarter of 2013 that the stock market actually took up growth stocks. 2012 was really not a great year for long short equity, and people just didn't want to be long equity. 2013, growth stocks finally took off. To me, though, this is a structural reality of technology. It's only going to get cheaper and cheaper to enable the best minds or combination of minds to create something that has value and even greater value because of, just because of the ubiquity now of tech in our own lives and increasingly in our industries. So I could say that multiples in tech in a way have never been higher. Multiples in the US are very, very high. Really maybe the market actually understands, like, I'm gonna stay with my A student bet. EM has underperformed the US for eight years. Value has underperformed growth for a good 8 years. I don't know when that's ever gonna change. Like, I think this is a structural reality that as tech only penetrates more and more of our lives, gets cheaper and cheaper, it enfranchises the best. And the US, Europe's not gonna catch up to the US in technology. Japan's not. We're partitioning China, and China is using technology actually with the state in a way that we never have comprehended. That's actually a risk for us because they've developed their own ecosystem. So I guess I could say that now we're in a very different situation with tech. The S&P and NASDAQ has become a software company. It started as an infrastructure company in the late 90s, building the internet, and the pro-cyclical capex phenomenon, for the country. But now it's like low-cost applications plugging into all that infrastructure, all that knowledge, these ecosystems. Like I look at this as now structurally, the winners win even more, and the best human capital around the world will come, to the winners. And so in 2012, I developed a very, very strong view that San Francisco was real estate was a huge long, tech was a huge long, but that's from someone who, not an engineer, don't claim to understand tech better than someone else, but structurally it made sense. And I don't see it mean reverting. I don't see how that's going to mean revert. And it led me to actually be negative on EM from about 2013 on. And I don't think I'm ever gonna want to get long the D students in the class, the C and D students in the class. I don't see they're ever gonna catch up. Chinese internet is different. That has to win. That is winning China, but the state is essentially, commandeered that. And so I think we're in a situation where all industries are now becoming, tech businesses. I mean, they're integrating tech, and the demand for it, the agreement in it, the legislation of it. It's just one path. I don't see how it reverts. So I can make a case that the S&P just goes to new highs. It pays a dividend. They're liquid. Once we get through this recession, there's enough policy. That's where you're going to want to be anyway. By looking at the rest of the class and their poor health, I'm believing that the Fed is eventually going to recognize this because corporates are global players now. They weren't really 10 years ago. Now they are. The trade war is a huge event, and we see slowing in commodities. We see negative rates around the world. There's a limited number of policy responses that can happen until we get after the election, I believe, in the United States. So I think the course is to lower rates and very aggressively. But we need the Fed. People need to bet against the Fed finally and win. You couldn't do that since the crisis. You had to go with the Fed. That was the only way to win, was go with the Fed. Now you have to change and bet against the Fed to win because they're not very good analysts. They're not very good doctors. And I think they're going to realize, oh my gosh, we have to cut. And the S&P is not the symptom here to follow. It's all these other things.
Well, that gives me a segue to what I wanted to talk about the final section, because first of all, I want to recognize that it appears like what you're talking. I think you are in somewhat of a contrarian minority of people thinking that in equity markets or like regional markets think are not going to mean revert, because I hear so many people saying that how value has to eventually mean revert with growth, how emerging markets have to mean revert with US markets, how small caps and large caps have to mean revert. And it is interesting to hear your perspective that you have a very strong opinion that it's not going to mean revert, which means that for listeners, for investors,
I'm saying
they may have to
very good chance it doesn't.
Yeah, and they may have to get in and continue on a trend which is already very mature and might continue. And that goes back to the trade we're discussing, because as you mentioned earlier in the talk, how like last year or even earlier this year, nobody was thinking about betting on rates falling. I had a similar experience.
Not even as a hedge.
Yeah.
Not even as they couldn't put it together.
Yeah.
It was like the financial crisis. Like, hey, these subprime mortgages are worth zero and they're 30 times leverage. That means there's probably a real problem in the Wall Street. And people just, it never happened before.
People just
so
don't do that.
They couldn't imagine it.
Yeah, people cannot trade on anything. People can never trade on a pattern which is not happening right now. And I had a similar experience in 2018. I called my bank coverage and I asked to price some floors. Floors, again, for listeners, that's a options bet on a falling interest rates. And they're saying, well, interesting, you're asking for floors. Everyone is asking us for caps. We have no floors and floors. I was like, yeah, I want like 100 basis points out of the money floors. And they were like totally dumbfounded that they even wanted to ask about that. All hedge funds asking for caps. So that was, but it was good to have that insight and that conviction at the end of 2018, at the beginning of 2019. Now, this conviction already had run quite a bit. The trend is on. If you were mentioning that you kind of want to focus on the mid-2020 as the interest rate bets. Now, implied LIBOR rate, which is the rate which London Interbank Offer Rate, which is basically driven by the Fed policy, at the height of the interest rate hiking craze, possibly was like 330 during that time. And now it's fallen as low as 1.5% on that sector. So we already run more than, assuming that zero is the final destination, and it's usually not quite zero, we're on quite a bit of that road.
That's true.
You're using options, so you could buy call for 5 ticks, and we could choose pick your own poison, what calls, what strikes.
I can go through some of them.
Yeah, maybe give an example and see like where they've gone, where they were, where they're now, and where they might be going.
Sure.
In your opinion.
So I have to refer to this sheet. So the question is, what's the payoff for various levels? I mean, when this is kind of like betting on a bankruptcy, right? It's kind of like betting on Enron, where it was one of the biggest companies, or EIG, or whatever. You could say it's like betting on Tesla right now. Like when a company's got 30 or $40 billion, it's hard to imagine it going to zero, right? Even though the debt and Tesla trades, I don't know, probably in the 75, 80 cent range. The question is, for me, is what is the risk? How much risk for what kind of multiple? And so we've been focused on like 20, 25 delta calls. Because the belief is, hey, if this company is going to miss its earnings dramatically and it's really levered, it's going to go to zero, right? The market's eventually going to realize and take it down fast. So I think it's kind of like that. The economy is not growing at the rate that the Fed thinks, that the rest of the world is pulling this down. The future perspective on the trade war and other things is shifting negatively, and you have that risk of downdraft, which is just validating where treasuries are trading. So the question is, it's only so often that you can, confidently find multiples appreciation. Long something is where you can get multiples, but it's hard. It's hard in a deteriorating global economy to find that kind of thing. I mean, if you have this, outlier bet, hey, this company is not only going to miss its earnings, the leverage is going to overwhelm the equity, and it's going to have to be, going to get priced to zero. There are bets in fixed income that you can make that hedges out whatever risk you have on the long side, that would be potentially collateral damage. To me, with those payouts relative to the likelihood, it's funny, people kind of agree, like if things are bad, they're probably going to go to zero fast. But they seem to monitor things by, whatever they look at every day, like the S&P, and like, hey, it's not happening because, hey, these things aren't going down. But I don't know anything else that could possibly protect you better than
against things going really bad, right?
It's just getting to that tipping point of recognition. What the market, I guess, is probably looking for is the Fed to show. We have a whole month, the end of July before the Fed actually reaches its verdict, and I think the Fed doesn't want to do this. They don't want to be wrong. They don't want to have to go through this. Maybe they don't want to have to encounter going back to extreme policies. but they do talk about it. And if they do have to do that, I think they're going to go to zero pretty fast. In fact, that would be the choice, right? They get there as fast as possible and then discuss, negative rates or some other, rate targeting or whatever. So it's one of those things, like they either do have to do this stuff or they don't. And if they do, I think they go to zero, which case the betting on zero scenario, you can make real serious returns. And obviously the sooner it happens, the better. The rates market generally is saying most of the rate cuts are going to happen by June in the next year. But I think the ending rate is way too low. There are not enough people who believe this, although it's only been the last couple of months that the exposure to Eurodollars is positive. There's really no reason to believe in lower rates in a hiking cycle, right? And it was only until the middle of last year, right? People were believing in higher rates. So this is a huge shift in forward expectations as evidenced by rates markets. And the question is it going to go all the way to zero or not? And if you remember 2000 or 2007 or 8, you just don't say, oh yeah, it's at zero. No, it's like a day by day, month by month valuation process until you get to a bottom. And usually the bottom is way farther than anyone expected. I remember in 2008, there was one strategist on Wall Street, one, who thought we were in a terrible scenario. One, it was David Rosenberg of Merrill Lynch.
I know David Rosenberg. Yes.
He predicted the S&P earnings were going to be about half of what the average was. It was really interesting that there was a strategist who thought that until the Fed just declared that they're likely to cut. Goldman Sachs was saying they believed in hikes. They totally didn't believe any of this for whatever reason. And there were a few other banks who totally disagreed. The Fed has now made it clear there's a likelihood, but there's still a big fight and struggle against this concept.
So on your trade, I was just kind of thinking of it like buying those calls on Eurodollar futures, making this long shot bet. It's a little bit like if you think of investing like at Google or Amazon at IPO.
Yes.
If you thought several months ago you could invest in those things at IPO and you could already make 5 or 6 times your money, right?
Yes.
And now we're at the juncture where many investors might be turned off by the fact, like, oh, we already missed 180 basis points of the move.
That's normal. That's normal behavior, right? We've already missed it.
Yeah, we already missed it. But as you mentioned, in 2002, you could have very easily said, like, I missed 200 basis points of the move, but there was another 250 to come.
Yes.
In 2008, the same thing. And also, we have more information coming in. And if we're always, all the trading wisdom says that most money is made not at picking the bottoms, but like going with a trend when it's middle cycle as a trend established. So your feeling is that that's how investors should be looking at it, that we have right now established trend, which with very high probability takes rates to zero, and people shouldn't look back at when they would have done something, regardless whether they have position or not. This is a good flow, right?
Yes. So I'm not an expert, but I've been focusing on this for the last 9 months and 6 months, particularly in these Eurodollar calls, and I am long a number of other markets and things. I'm not choosing to be long. I'm long a lot of private, companies, but I'm not choosing to be long NASDAQ and the S&P. I think the multiples are high and there's vulnerability. But what started as a hedge is now the trade, which is kind of like subprime. I did subprime to protect, because I thought to protect my EM and commodity longs that I thought were very vulnerable to a shock. And that became the dominant trade. I'm seeing this as the dominant trade, and it's been reassuring and reinforcing that people aren't positioned for this. They're now positive. So now hedge funds, et cetera, are now positive. But Raul has told me, I trust his view of canvassing the street, that almost nobody has had the trade on. That's reassuring to me, right? Because if this is real, they're going to have the trade on. So it's just gone positive in terms of exposure. And everyone who was short, maybe they believed in inflation, maybe they believed in growth because of policies, maybe they believed in, who knows, they've lost a lot of money now, right? They're being forced to cover. It's, you could also say it's like, a stock that there's a heavy short interest, and I think of like Snapchat, where it's like, oh no, it was like promising, and then it goes down tremendously, and it's going to get wiped out. And then they change a few things, and suddenly, people cover their short, and now suddenly it's like tripled. we're in this kind of dynamic where people are having to realize they're wrong. They're forced out of it. They're forced into it. And now the Fed has validated, yes, so it's easier, less controversial to put the trade on. I do worry, of course, what could change this? But when the Fed talks about, an insurance cut like 98, I'm like, we're in an entirely different situation than, that CapEx cycle, in the U.S. and the build out of the internet and where we were in the world, and it's just demographically completely different than where we are now. So I think there's still this opportunity, and so I now actually evaluate, like, I'd rather put money in this trade than almost anything else. And the question is, how much of a portfolio should one have in this trade? And I'm waiting for. I think that there's a chance we go sideways into the Fed meeting, getting data, et cetera, because we're way above the 50-day moving average now. If I've looked back the last 5-6 years, and often the Eurodollar moves sort of they go up and they hug the 50-day cycle until they break. It's a pretty steep chart. If you just look at the chart, you'd say, I want to be long that security. Like, every time it drops, it recovers very quickly. So my biggest concern is that, now the news is out. The Fed is going to cut. The question is how much, how fast? And I think the risk is we go sideways for a while, which we decay at about 3 basis points a month. But I'm trying to make, hundreds of basis points. So I think this is a pretty good trade-off. We're going to get more information. And I also know that I can fit it to what my risks are. I believe my risks are on the long side. And but what's happened is it's expanded, right? It's expanded a lot, and now
you have actually some money at risk, right? It's like with
Yes.
Bitcoin. You make it 1%
Exactly.
of your portfolio, then suddenly it's 20% of your portfolio, right?
Yeah, pretty much. Yeah. I'm very sure that our understanding of this trade will be radically different at the end of the year than it is now. There's going to be so much news, so much more data. It's either going to be confirming, and they're going to totally reevaluate their policies, or there's going to be some reason, again, it could be the dollar. I think we should talk about the dollar. The dollar sold off in June, right? When it became clear to the market ahead of the Fed that they are going to cut. So this was after a pretty long buildup. It's not at a new highs, but the question is, do you think the dollar is going to keep going, or is it going to now recover? Because in a contracting liquidity environment, it should recover. So, but if the dollar for some reason was going to drop, that would help, global liquidity. I do not believe there's much of a chance of Trump and China fixing things. I think we're past that. I think there's too much agreement. Like this, yesterday, Rubio said, no way is the Senate going to allow a Huawei, agreement. So I don't see how that's gonna happen. So let's talk about the dollar.
Well, that's a long conversation. I almost feel like a dollar will deserve like a whole separate interview. But I do agree with you that dollar is at the heart of things. If anything, my thesis is that the whole reason why rates have to be cut is not so much because of any kind of catastrophic situation in the U.S. economy, but because if you don't cut rates, there will be no stopping catastrophic dollar rally versus currencies which have negative yield. Because dollar and euro have relatively the same inflation rates. You cannot have real rates different by 3% forever. It'll just blow up the whole global financial system. You cannot forever do it because it's not sustainable. Rates have to contract to like a reasonable range, and that's something you alluded to. So I totally subscribe to this.
So when I see the dollar rally, I'm like, this trade is going to work. Our rate trade is going to work incredibly well. And in June we had the S&P rally a lot, and we had the dollar fall. Gold went up a lot, but the last 2 days we've seen the dollar. Actually, today the dollar rallied strongly. We saw copper fall strongly. We saw the oil fall strongly. So I think we're at the midst of a recovery, a bottoming of the dollar, and when it starts moving up, I think accelerates this trade.
Well, I agree with your dollar view, but my last question I want to say, like what I want to talk about in conclusion, you mentioned that what you can kind of both view this as a trade, and you can view it as part of a larger portfolio.
Yes.
And portfolio construction as a whole, again, subject for a whole other interview.
Yes.
We could also talk about gold and how gold plays out in this, because that's a whole other subject.
I do wonder, like, let's say this is true, right? Let's say within the next 6 months, it's very clear they're going to zero. And we know in rate cuts, they cut every month, right? They don't like wait a quarter, cut, wait a quarter. That's kind of what the market's saying. They're going to wait a quarter, going to cut, wait a quarter, then a cut. No, I think they're going to have to cut really fast. And even maybe it could be 100 basis points, when they realize, who knows? But the point is, once they get down to zero, the question is, what do you do next, right? And gold, the question of gold, and I've been involved in gold for a long time, for 15 years. The quality of the managements and the miners and the business is not great. It's really lousy, and it's been an 8-year bear market. Most commodities have been terrible. But I can imagine that once that happens, that what's left for them to do, and what's left for them to do, particularly because politicians now, particularly on the left, think it's okay to forgive $1 trillion of student debt or to pile on deficits because the treasury market doesn't seem to mind. So it is gold and other inflationary benefiting assets may have a really big move later after we get through the cycle. We just don't know what actions they're going to play. But right now, I think the play is bet on where the Fed funds settles is the trade, is your best hedge, and later we'll see where we get.
And so the last question, when you allocate a portion of your portfolio to this trade, you obviously, you laid out your arguments, but we both know that sometimes things don't play out the way we think. Are you prepared to say, if I'm wrong, this is just going to go to zero? This whole thing is going to wipe out. Of course, I don't want to, it's delicate. I don't want to ask you about your exact portfolio management. That's your own kind of private internal strategy. But in your mentally, are you preparing to say, I'm making this bet, I'm trying to make 5 times X.
Yes.
In a mediocre scenario, I'll make 2 times X, but I'm prepared to wipe this money to zero and go on with my other trades and live to fight another day. Is that your mentality, or do you thinking that you will somehow manage out of this trade without losing 100% of premium?
Well, the good thing is that there's virtually no chance they're going to hike now, right? Right. So it's not like there's going to be some spike in demand in the world that we don't see coming, like a legislative, and we're in this second 2 years of the Trump, we're in a pre-election cycle period where they disagree. It's going to be hard for them to agree to do that stuff. So question is, would I let this go to zero over a year? Well, probably not. I would probably not. But it would also mean that a lot of things have happened, a recovery in the ISM and manufacturing and corporates, it's just, that would have to happen. So no, I'm not willing to do that. Or I would just size it to where I would be okay with that. What's interesting is that I always thought that, equity people were willing to take more risk, played for bigger stakes, and fixed income people were the opposite, right? They're going to be conservative, or bond market people conservative, and that you attracted a different, kind of personality. So what I've talked to people who just do fixed income about this, or institutions say, oh yeah, I've got that trade on, and I'm like, what is the trade? Oh, well, I'm long, 10 years, I'm long 5 years, I'm long 2 years. And then the question is, well, how levered up are you? How confident is this bet? Usually, they were talking about getting a 20% or 30% return in a really good scenario. And I'm talking about getting a 10x return in a scenario. And so in a way, I'm bringing a risk-seeking mindset to this trade for a lot of people who aren't used to having this maybe optionality or aren't seeking this kind of risk. I now can understand why Druckenmiller could have made so much money, in these times, right? A risk-seeking mentality in an incredibly liquid, leverageable, area. I get it. I get that now. And if I had to do my career differently, I would have been trained about rates on the sell side early in my career, so I could have made this part of it. As I've socialized this with other macro guys, I've realized they don't have expertise here either. This is not a normal thing. So it's actually been a recognition of a separation between equity people and rates people. But you kind of needed to have a macro viewpoint to see the disease or the lack of health here and why it would be applied to the U.S. And so as belatedly, I've come to recognize this as an inefficiency, you might say, in the market. But I'm playing with an idea that it's worth playing to try to make 5x here in the next year. I don't think I can make 5x or even 50% in most things, and I do actually better in a dislocation. So right now I'm believing that's the path, and if I think it's going to change, then it's probably going to be apparent, and I would reduce my risk.
Okay, well, thank you very much for taking your time. It was great to have you on Real Vision. Great to have you in this office. Always a pleasure to have a good conversation about markets. Thank you very much.
All right, great.